There's no basis for either statement. So you can just erase those, 50% rules, those hard and fast rules out of your head, because like everything else in the tax world, it's a facts and circumstances situation. Unfortunately, for reasonable compensation, it would make life a lot easier if the IRS just said, this amount, X amount is reasonable comp. The rest can be distributions, but that's not how it works. So it's facts and circumstances, which means it's open to interpretation. This particular topic is interesting because if you did have a client go through a reasonable compensation audit, they're going to be held to some standard that is not very clearly defined. So I think that's what makes reasonable comp kind of challenging. And that's why I use RC reports, because it takes some of the guesswork out of it. And we'll get to that in a minute. And I want to be clear, I am not representing RC reports. I am not paid to plug their software. I'm not one of their advisory council people. I just happen to like the tool. There are probably other tools that do similar stuff. I just don't know them. So this is the one I'm talking about. So I think we all know generally that reasonable compensation is the pay to an S corporation shareholder for services they provide to the corporation, right? Like any other employee, you provide service to the business pays you a paycheck. That's the same thing for an S corporation shareholder employee. And for the purpose of today's discussion, we're gonna distinguish between shareholder employees and non-shareholder employees, right? Reasonable compensation in this case applies to shareholder employees. So it's the wages or the salary in exchange for services provided to the S corporation before non-wage distributions can be made. So we've talked about this before. Are S corporation shareholders required to be on payroll? The answer is it depends. If they don't take any money out of the company, let's say the business isn't profitable yet. Let's say they made the S election before they spoke with you. They shouldn't have, but they did what they did. They're not actually making any money. Maybe all the money's going out to pay just operating expenses. So if they're not taking any distributions either, then they don't have to take payroll. But if there's even $1 of distributions, it has to be payroll first. And there's a couple of places where you can find that information. One of them is on the 1120S instructions. It says distributions and other payments by an S corporation to a corporate officer must be treated as wages to the extent the amounts are reasonable compensation for services provided to the corporation. That's a whole lot of words that basically just say, like any other employee, you have to pay them wages if they provide work for the company, right? Like if you have an employee who is working every day in the business, you can't just make them like payments under the table, right? You have to pay them as a W-2 employee for the services they provide to the business if they meet the criteria to be treated as an employee. Same for shareholder employees. So if they work for the company, you got to pay them. Then the next question is, how much do you got to pay them? There are, and I took this directly out of the IRS, an IRS kind of like FAQ site. So this is non-authoritative, and I'm going to link you to that site in a minute. We're going to look at it. But this is its instruction for determining reasonable compensation. So while it is non-authoritative, because we all know that IRS FAQs are not an authoritative source, it's on the IRS website, so it might be a good idea to take a look. So they suggest that the first step to determining how much a shareholder employee has to be paid is to look at how the S corporation earns its money. And an S corporation and any other business can earn its money from three primary sources: services provided by the shareholder, services provided by non-shareholder employees, and then capital and equipment that they can make money on, right? Those are the three main sources. It's either the owner doing the work, it's everyone else doing the work, or it's the assets doing the work. That's how you make money. So gross receipts generated by non-shareholder employees and the capital and equipment are available for distribution. Gross receipts generated by the shareholder's personal services to the company need to be paid to the shareholder as wages. I don't necessarily like that description. It does help give me a little bit of a framework, but like, how do I tie every specific dollar that comes into my business to what I do versus what my employees do? So for me, that still keeps it a little murky. It does go on to point out though that shareholder compensation is based not only on the services that they provide directly that earn revenue directly for the business, but also for all of the time they spend on administrative tasks supporting non-shareholder employees. So for example, if I structure my firm so that I'm not doing any client direct work, right? Like I'm not doing any of the bookkeeping, I'm not doing any of the tax returns, I'm literally just running my business and supporting my team. That's not a way to get out of paying reasonable comp because that administrative time is still considered services to the company. Oops. We've probably all seen some variation of this as well. So factors in determining reasonable compensation. And this is kind of what RC Reports questionnaire is based on. It looks at what services the shareholder employee provides to the company, and then how much time they spend on each of those types of services, right? So it'll depend on your training and your experience, your duties and your responsibilities, the time and effort that you devote to the business, how much of the work is done by key people versus yourself, what types of compensation agreements are in place, whatever formula you use. John points out one of the interesting twists on the comp rules is that a shareholder loans funds to the business and later removes those funds without a loan document. That money should be treated as wages to the extent that reasonable comp has not been met rather than a distribution. That is a twist. And I think the logic behind it, it's basically it's making sure that you can't get around distribution rules and wage rules, right? If you put money into the company as a contribution, that's capital. If there's no loan agreement in place, then we can't call it a loan, right? Because a loan has a criteria. There has to be the amount, there has to be a repayment period, there has to be a stated interest rate, or at least an implied interest rate. And if those things don't exist, then you don't have a loan. So in that case, it's just distributions in disguise. That is a good point, though. So there are a ton of factors in determining reasonable compensation. And I honestly, as much as I love advising my clients and helping my clients stay compliant, that's a big part of what we do. I'm not really qualified to make that assessment for every single industry, for every single client, right? Like I just don't have that knowledge base on my own. But like with anything else in our firms, we use tools, right? We could probably do a tax return, pen and paper, but we use a software tool to make it easier. I probably could do all the research and come up with recommended salaries for different industries based on how much time spent where, but there's a tool for that. So I'm not going to spend my time doing it all manually. So, it sounds complicated. And what can we do to help? We can offer guidance. Now, this is a thing I suggest that you get paid for, right? Preparing an S corporation tax return and advising your client on reasonable compensation are not the same thing, right? Tax returns are reactive. They report things that already happened. That's compliance. Advising and making sure that they don't run afoul of rules and stay ahead of the curve, that's advisory. So if you are offering reasonable compensation guidance to your clients, I do suggest that you get paid for it. Now, how much you get paid for it is up to you. Here's where I share. I happen to like RC Reports. I am not being paid to plug RC Reports. I don't know anyone who works at RC Reports. I've not been asked to represent them in any way. I just like the simplicity of the tool, and so that's the one I use. So some suggestions that I have for you if you're taking on S corporation clients. For new to you S-corp clients, they've already been an S-corp, they filed with somebody else, I suggest you have them complete a reasonable compensation survey. Even if they already are on payroll. They're new to you, so you're starting this new advisory relationship. So I suggest that you complete a new report. If you're helping clients make an S election, in my opinion, you're duty bound to make sure that they're following the rules. If you're the one suggesting S corporation and you're the one helping them with the 2553, you should really be the one helping them figure out reasonable comp. So new S corporation clients, have them complete a survey. I do recommend that you have existing clients complete new surveys on a periodic basis. I have in here annually. You don't necessarily have to do it annually, especially if you have a whole lot of clients. That can be kind of burdensome to keep track of. But I do recommend that you have them complete it periodically, maybe every other year, because the things they do for their businesses change, the offerings of their business changes, so it's possible that their pay should change. And so this isn't just a one and done, you have a report from 10 years ago and that's the one we're going to live on forever. This should be thought of as an ongoing service between you and your clients. Any questions? Anyone have S-corp clients? I'm curious. Does anyone have an S-corporation client who does not take payroll and just flat out refuses to set it up? Yeah, right? Like, we all know that not everyone gets great advice, and maybe we've been guilty in our early days of not giving great advice. So it's possible that they had somebody help them set up an S corporation, or they did it themselves. I've had a couple of people do that. Someone said they should be one, so they figured out how to do it. And then they weren't told the rest of the story. They weren't told the rest of the requirements, or they were told and forgot, whatever. For whatever reason, they never set up payroll, and their previous tax professional let them get away with it. Never said anything, didn't make it a requirement. My suggestion to you, and we're going to talk about this in a minute, my suggestion to you is that if you are going to work with S corporation clients, you help them get compliant. If they're not already doing payroll, help them get compliant going forward. And if they refuse to get compliant, you may want to consider disengaging, because you as the tax professional are technically submitting an inaccurate tax return, in my opinion, an inaccurate tax return if it doesn't include payroll. Now, there have been tax professionals that have gotten in trouble for failing to require reasonable compensation and then filing tax returns without it. So you should tread lightly. I'm not saying run off and fire all your clients, but I'm saying that if you have an S-corp client who's not taking payroll, this might be a great time to have a very frank discussion with them. And part of that frank discussion might just have to be that while you enjoy working with them, you value your business as well, and that you can't continue to prepare inaccurate tax returns for them. Pronto Tax, Imelda said, I saw an article on a CPA. I'm not sure if you shared it. Yes, I think I shared it with you all a while back. I think, Imelda, I sent it to you. There was a CPA who ended up being fined. I forget how much. I mean, it was like 6-figure fine for filing S corporation tax returns without payroll for the S corp shareholders. And obviously that wasn't just a one-year thing, it was a repeated thing. But then once that CPA started getting audited, they found all these other returns that he hadn't done the reasonable comp thing for. So it is possible that you can get in trouble for it. So I just recommend that if you have clients who are not taking payroll, that you help them get compliant. And if they flat out refuse, then it may be time to look at alternatives, right? So if they flat out refuse because they can't afford payroll, I'm going to suggest that there probably should not be an S corporation. And maybe you need to look at either revoking their S election or withdrawing it if you're in the time frame to do that. Reba, you got a question?
Yeah, I have a client who's like 70 years old, and ever since he started his S corporation back in the 90s, he's always just put money over on a Schedule C and paid self-employment tax on that. And he just will not put himself on payroll. I've even had him sign documents stating that I've explained to him, that he is required to be on payroll, that he knows he shouldn't be flowing that over to the Schedule C. So is that going to offer any protection for me at all, or?
So one of the last slides today, I'm going to touch briefly on the 1099 workaround. And we can actually jump to that because, I see that a lot. Like, oh, we'll just drop whatever reasonable comp should have been on a 1099, reported on Schedule C, they'll pay self-employment tax, voila, same end result. I will say, while it does achieve a similar end result, which is that self-employment tax is paid versus employment tax being paid, but either way, the taxpayer is paying into Social Security and Medicare. The first thought I have is, does that shareholder employee meet the criteria to be treated as an employee or an independent contractor? If they meet the criteria to be treated as an employee, they have to be paid as an employee, just like anybody else. So those same rules apply. So that's thought number one. I have not found any official guidance to support taking that position, but I also haven't found any official guidance against taking that position other than the employment rules. If they meet the criteria to be treated as an employee, they have to be paid on a W-2. And Tanya points out it may also be violating state labor laws, right? If they meet the criteria to be treated as an employee, then there is no basis to pay them as a 1099.